Novo Nordisk delivered strong sales and profit growth in the first half of 2025, with second quarter revenue rising approximately 18% at constant exchange rates, supported by pricing momentum and demand for GLP-1 therapies. Operating profit rose approximately 40% in Q2 and 29% for the first 6 months, both at CER, reflecting improved margin performance and operational leverage. Diluted earnings per share reached approximately 5.96 Danish kroner in the quarter, contributing to a 6-month total of 12.49 kroner. Despite this strong performance, the company cut its full-year guidance, now expecting sales growth of 8 to 14% and operating profit growth of 10 to 16% at CER, citing slowing growth in key US markets and increased competition. The revisions also reflect the impact of prior period gross-to-net adjustments of around 3 billion DKK related to the 340B program, and cost absorption from the acquisition of 3 Catalent manufacturing sites. Financial detail from the Q2 report shows that the US market, which contributes a significant portion of total global revenue, experienced slower demand for both Wegovy and Ozempic. Despite efforts such as the direct-to-patient NovoCare pharmacy and telehealth partnerships, Wegovy penetration in both cash and insured channels fell below internal expectations. Novo anticipates partial margin recovery through updated label expansions and formulary placements. For example, Wegovy became the only GLP-1 covered under the CVS National Template Formulary effective July 1, 2025. Novo Nordisk's balance sheet is exceptionally strong. As of Q2, the company holds over 60 billion DKK in cash and equivalents, with minimal debt. Free cash flow guidance was adjusted downward to between 35 and 45 billion DKK for the full year, but remains robust given the scale and margin profile. Capital expenditures have increased modestly, largely to support the expansion of new manufacturing facilities acquired from Catalent, but remain largely covered by operating cash flow. Gains on hedged currencies are expected to generate net financial items of roughly 3 billion DKK in 2025. On a technical basis, Novo's ADR, ticker NVO, fell sharply following the earnings and guidance cut, dropping over 20% and breaking below key support levels. Shares have moved below both their 50-day and 200-day moving averages, with the most recent trading around 5,400 USD, against resistance now near 60 to 65 and support around 52. The RSI dropped to oversold levels near 30, while trading volume surged, suggesting capitulation rather than strategic rebalancing. However, the longer-term uptrend remains intact as the stock remains above its longer-term moving averages. From a fundamental standpoint, even with weakened guidance, Novo continues to generate high returns on equity, often exceeding mid-30%, and maintains one of the highest gross margins in the pharmaceutical sector. Its reliance on Ozempic and Wegovy constitutes a concentration risk, yet these same blockbusters deliver outsized profitability and free cash flow. The forward price-to-earnings ratio trades at roughly 30 to 35 times, still premium, but reflective of the company's dominance in obesity and diabetes treatment. EV/EBITDA multiples near mid-20s reflect both growth and margin resilience relative to broader pharma peers, which typically trade in the mid-teens. Industry context shows that global obesity and type 2 diabetes continue rising unabated, with nearly 1 billion people affected globally, but only a few million currently receiving GLP-1 treatments. While competition from Eli Lilly's Zepbound and compounded semaglutide alternatives has intensified, Novo's global reach, regulatory approvals, R&D pipeline, and infrastructure investments provide strategic differentiation. Litigation and regulatory interventions aim to curtail unsafe compounding, but their timing and enforceability remain uncertain. Novo has elevated CEO Maziar Mike Dousdar from international operations to lead the company starting August 7. His track record of revenue growth in emerging markets, combined with internal restructuring of R&D leadership, aims to revive commercial execution in the US and accelerate the delivery of new drug candidates. Novo's next major catalyst is regulatory review of Wegovy for MASH treatment, expected second half 2025, which could unlock a multi-billion-dollar market segment if approved. Overall, Novo Nordisk's latest financials reveal both underlying strength and emerging risk. With solid free cash flow generation, a deep backlog of R&D assets, and leading position in a growing global market, the company remains exceptionally well-positioned, or at least structurally resilient. The drastic share price drop offers a potential entry point for long-term investors, provided confidence in stackable drug pipeline and effective leadership execution returns. On balance, despite the lowered guidance and heightened competition, Novo Nordisk merits a buy recommendation at current levels near $55 per share. The stock appears undervalued relative to its long-term franchise strength and cash generation potential. A 12-month fair value estimate using conservative DCF assumptions such as revenue CAGR around 12 to 15%, terminal growth of 2.5%, and a discount rate near 8% supports a target near $65 to $70. If the company regains its prior momentum, key risks include intensified generic competition and compounded drug substitution in the US. Further profit warnings, regulatory or litigation setbacks regarding R&D or safety, and currency headwinds. Upside catalysts include progression in MASH indication approval, acceleration of new GLP-1 variants such as the dual receptor molecules or CagriSema, renewed commercial execution in the US, and improved pricing or take-up in international markets. Novo Nordisk remains one of the most promising large-cap plays in the obesity and diabetes market. While 2025 may be a reset year, the company's scale, innovation engine, and global footprint support a long-term growth thesis, making it an attractive opportunity for patient investors.